All right, let's just dive right in. We are living through, I think you'll agree, one of the most complicated financial times in recent memory. You've got markets that are just roaring, trying to push for new highs, but at the exact same time, there's this mountain of government debt that feels, well, almost unreal. So in this breakdown, we're going to unpack that exact dilemma. How on earth are you supposed to navigate a market that's being pulled in two directions by massive debt and the all-powerful Federal Reserve?
This quote really hits the nail on the head. It's the perfect place to start. What it's saying is that no matter what you're investing in, stocks, crypto, real estate, you name it, it's all happening on a stage that's been set by the government's own financial health. You just can't analyze a company's prospects without first acknowledging this huge economic backdrop. This shadow, as they call it, is the context for every single decision we're about to talk about.
And just how big is that shadow? Well, here's a number that you don't hear about every day. $100 trillion. Yeah, according to our sources, that's the estimated scale of all the promises the government has made that aren't officially on the books. Think things like Social Security and Medicare down the line. It is a mind-boggling figure, and it points to these deep, kind of hidden obligations that create a ton of pressure and instability on the whole system. So here's our game plan for making sense of it all. First, we have to understand the shaky ground we're standing on, this debt-fueled market. Then we'll try to decode the signals from the most powerful player in the game, the Fed. After that, we'll explore two totally different playbooks investors are using, the slow and steady hunt for cash flow versus the all-or-nothing bull versus bear showdown. And finally, we'll pull it all together so you can start to forge your own thesis. Okay, so let's get right to the heart of it. The biggest challenge for any investor today, really, is that our market is built on a level of debt that is just historically off the charts. And this isn't some small crack in the wall. We're talking about a potential issue with the entire foundation. Understanding the sheer scale of this is absolutely crucial. And this slide really puts it in perspective. Look, the U.S. public debt is now sitting at around 120% of our entire country's economic output, our GDP. I mean, that's a level we haven't seen since World War II. And when things get shaky, the main tool they use to prop it all up is something called quantitative easing, or QE. Now, you can think of QE as the central bank essentially printing money to buy its own government's debt, injecting cash into the system just to keep things running smoothly. It's this cycle of more debt, more intervention that really defines the market we're in today. Which, of course, leads us directly to the conductor of this entire orchestra, the Federal Reserve. In an environment like this one, the Fed's decisions on interest rates can honestly have a bigger impact than the earnings reports from even the biggest companies. So a huge part of the investing game has become this art of Fed watching, trying to guess what they're going to do next. And this is it. This is the multi-trillion-dollar question on everyone's mind. Right now, the market is betting heavily that the Fed will cut interest rates. The idea is, to make borrowing cheaper, get people and businesses spending again, and give the economy a little boost. But here's the catch. Cutting rates means cheaper money, which means more spending. And when you have too much money chasing too few goods, well, that is the classic recipe for kicking inflation right back into high gear. This tension is the central drama that has all of Wall Street on the edge of its seat. So with all this uncertainty, how do investors even try to see what's coming? Well, one of the most important tools they use is something called the yield curve. It sounds super complex, I know, but it's really just a simple chart. It shows you the interest rates you can get on government bonds over different lengths of time, from a few months all the way out to 30 years. And the shape of that curve is widely seen as one of the best fortune tellers for the economy. Okay, let's break this down because it's so important. In a healthy, growing economy, you get a normal yield curve. It just means you get paid more interest for lending your money for a longer time. Makes sense, right? But when the curve inverts, when you can actually get a higher interest rate on a short-term bond than a long-term one, that is a massive warning sign. It's the market screaming that it's more worried about the immediate future than the distant future. It is a huge signal of pessimism, and as the sources point out, the fact that the curve has been inverted is a major reason for concern. So, given everything we've just talked about, record debt, an inverted yield curve, the Fed on a tightrope, how in the world do you actually invest your money? Well, one major school of thought just says, forget trying to predict any of it. Just focus on what you can actually control. And that brings us to the hunt for consistent cash flow. The thinking here is actually pretty simple.
If you feel like predicting where the market's going next is basically a coin toss, then maybe you should just stop trying to guess the toss. Instead, you build a portfolio, a system that's designed to pay you whether the coin lands on heads or tails. This isn't about hitting grand slams. It's about just consistently getting on base, collecting income month after month. It's a strategy built for survival. Let's look at a couple of examples of what that looks like in practice.
Now, in the world of real estate, one of the most popular cash flow strategies is what's called the BRRRR method. It's a 5-step system. You buy a place that needs some love, you rehab it to add value, you rent it out to a good tenant, and then, and this is the magic part, you refinance it to pull all of your original investment cash back out. Now that capital is free to go and repeat the whole process on the next property, and you're left with an asset that's paying you every month, but none of your own money is stuck in the deal.
You can apply a really similar mindset in the stock market using options. A popular way to do this is with a strategy called a credit spread. The easiest way to think about it is that you're getting paid to make a high probability bet. You're basically betting that a stock's price will not fall below a specific level by a specific date. For taking on that risk, you get paid a little bit of cash, called a premium, right up front. And as long as the stock stays above your line in the sand, you just get to keep that cash. Now, the trick to doing this right really comes down to two things. First, you have to make sure you're getting paid enough to make the risk worthwhile. A good rule of thumb from our source is to look for a premium that's at least 10% of your maximum potential loss. Second, you use the charts to find a price level where the stock has a history of bouncing a strong floor of support, which makes it statistically less likely to drop past your point and cause you to lose money. It's all about playing the odds in your favor. And this really shows you the trade-offs, right? There's no free lunch. Real estate gives you a physical asset you can touch, and it comes with some amazing tax benefits. But it takes a lot of capital to get started, and your money isn't easy to get out. Options, on the other hand, can give you incredible returns, and you can get in and out in seconds. But they also carry the risk of a really big, really fast loss if the market makes a wild move against you. Neither one is perfect, but they're both tools in the cash flow toolbox. Okay, so let's switch gears completely now and look at the other side of the coin. If that first strategy is all about ignoring the market's direction, this next one is about betting on it, and betting big. This is the classic, age-old fight between the bulls, who think the market is going to the moon, and the bears, who are convinced it's all about to come crashing down. Right now, these two stories are in a total tug-of-war. The bulls are out there saying, look, historically, the market's default setting is up. They're looking at those potential Fed rate cuts and seeing rocket fuel for the next big rally. Meanwhile, the bears are looking at the exact same data, the debt, the inverted curve, and they see a total house of cards just waiting for a breeze to knock it over. At its core, the bullish argument really comes down to the power of the Fed. Just like this quote says, a rate cut is almost always seen as a green light for stocks. It means cheaper money, which makes it easier for companies, especially in growth sectors like tech, to borrow, innovate, and expand. The thinking here is simple. Don't fight the Fed when they're actively trying to pump up the economy. But the bearish view says you can't ignore those sovereign fundamentals forever. You can't just defy gravity. This perspective argues that the underlying economic weakness is so real, so fundamental, that it presents a genuine opportunity to bet against the market, to go short. This isn't just about being a pessimist for the sake of it. It's about looking at the structural risks and concluding that preparing for a downturn is the only logical move. So just to recap the bull thesis really quick, it boils down to 3 main points. 1. The Fed is probably going to cut rates, and that's usually good for stocks. 2, inflation looks like it's cooling off, which gives the Fed the room it needs to actually make those cuts. And 3, a core belief that, when in doubt, the market's natural tendency over time is to go up. And on the flip side, the bear thesis is just as straightforward. 1, the staggering amount of government debt simply cannot go on forever without consequences. 2, the inverted yield curve has a nearly perfect track record of predicting a recession is coming. And 3, stock prices are already really, really expensive by historical measures, which could mean there's just not much upside left. So that brings us to the final and most important part. We've looked at the debt, the power of the Fed, and these two completely opposite playbooks. What are you supposed to do with all this? Well, the goal here isn't to pick a winner for you, but to give you the framework to build your own strategy. And that right there is the key takeaway from all of this. Even the experts are completely divided. There is no simple, easy answer. All we really have are these competing frameworks for trying to deal with this uncertainty. So your job, as an investor, is to first really wrap your head around the big picture problem. The debt, the Fed, and then very deliberately choose your tools. Are you going to be a cash flow investor building a durable system? Or are you going to be a directional investor, making a high-stakes bet on the future? And I'll leave you with this one final question to really think about. In an environment that's this complicated, this fragile, what's the real goal? Is it to swing for the fences, maximize every return, and try to win the game? Or is it just about protecting what you have, managing risk, and making sure you get to stay on the board to play another day? Your answer to that single question will probably define your entire approach to investing from here on out.